Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Edible Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim. Happy end of April.
Oh, wow. Something to celebrate, I'm sure. We'll all go by ourselves down to the park. And
every day that we are alive and well is a day to celebrate, Jim.
Yes, isn't it? And I don't know. See, for most of Canada now, spring is arriving. In Vancouver, it's been here since January. So, so welcome to spring.
Thanks. Things are greening up in Ontario, too.
The bear market rally, is this a good news for people who thought they'd pretty well lost everything when the market crashed on March 23rd?
Well, it's only good news if they use it as an opportunity to exit their positions or to reduce their risk exposure, because they came into the downturn in February. Most people came in very heavily exposed with inappropriate levels of equities, lots of dividend-paying things, preferred shares, all the goodies that they thought were going to outperform GICs. And in fact, those are the things that lost 30+% in a matter of 3 weeks into the March 23rd low. And so, what I always try and talk about is the fact that once you get into bear markets, especially bear markets within recessions, which is what we have unfolding right now, and arguably a bear market within a depression, right? This is the worst economic contraction in probably over 100 years. So when you have that kind of dynamic, and on top of that, you had stocks at the highest valuations, above the 90th percentile. There's only been a couple other times in history that you've had all that concoction of those factors together at once. And when you have had that, you see that stocks typically have lost half to 86% of their value over 17 to 34 months. So this is not a 6-month proposition where things go down and then bounce back quickly. This is typically a long slug out bear market that lasts over at least, a year and sometimes 2. And in that you have a series of dramatic drops followed by big rebounds, which is, also known as a suckers rally, but it can also be an opportunity to exit if you haven't yet exited. And we've had that, right? In the last month, we've had a really dramatic rebound in many of the things that plummeted in the February to March period. So I was just writing about that, and of course, this is our month-end letter going out to our clients today, and I wanted to take the opportunity to share some of that with the blog readers, because it's so important to understand that when you see a fast and furious rally, which is basically short covering, which is by the dippers, we knew that the rally in the last little bit was not likely to be sustainable for a whole bunch of reasons, but one of them was to do with sentiment and the fact that everyone was quickly back to how do we buy the dip, how do we play this, fear of missing out, FOMO, they call it, and rather than how do I manage my risk around this, how do I protect my downside, how do I raise cash if I didn't have enough coming into the first leg of the downturn. And so it's very important that people use them as exits from a burning building in a bear market. And just taking the financials as an example, in Canada, of course, the financials is a third of our overall index, and it's, Canadians love our banks. I don't know why, because we owe them tons and tons of money, and that's not a good thing, but we love our banks. And so people have that, and they have bank shares, and they have bank debt, and they have funds and indexes that are a third weighted in the financial sector. And so, they like it because it pays dividends, but unfortunately in this part of the cycle is where we start to see dividends come under fire, cash crunch causing companies to announce that they are cutting dividends and buyback programs, which have been giving candy to shareholders the past few years. So all of that really, did you catch, for example, Shell cut its dividend by 2/3 this week? It hasn't done that since the Second World War. So there's an example of a company that people thought of as, a stable dividend-paying stalwart that you could, they would never cut their dividends. Well, when you get into economic downturns and cash crunches, responsible management has to cut dividends. They have to conserve cash. They have to try and manage through the downside. And so, as I've mentioned before, shareholders got into the idea of thinking they got paid first, that cash came for buybacks and dividends before, and to hell with what was going on in the business, and who cares if it was sustainable and all that. Well, in this environment, the whole thing turns on its head. And so we got, a 16% rally in the financials as an example in the month of March, from the lows in March. And we had a rally similar to that 3 times in the downturn of 2008. From the fall of 2007 into 2009, the Canadian financial sector fell 57% in total, and it had 3 separate rallies within that where it roared back 15 to 20%. And each of those was another opportunity to take money off the table. So unfortunately, most people are programmed to do it the exact opposite, right? They're devastated in a loss cycle, then they're elated when things bounce, and God forbid they put more in during that phase, which is quite common if there's any cash that they hadn't, allocated before. Sometimes people borrow, Jim, to buy into these rallies, which is a catastrophic approach. People really shouldn't be borrowing to try and invest ever, in my view. Far too much risk. If you don't have the savings to wager, savings to lose, so to speak, why would you, increase your risk by borrowing money, so you'll have debt when the asset prices fall? So it's all these things together, but basically we have this opportunity of a rebound to reassess, to take some risk off the table, to build up cash, and to appreciate that we're really in this incredibly dangerous environment financially on every level. Workers have had a sudden stop in income. We've had a bunch of central banks throw cash at levered speculators who were going bust in, the February to March period, and they've allowed them to roll over a bit of debt or have a bit more, cash to get through a little longer. But this is not cured in the month of April. The coronavirus impacts, the shutdown of the economy is not going to go away in May. Even if we see a reopening of some sectors and places, as we are in the U.S., for example, we're not going to likely have a cure of any kind for this. It's going to continue to cycle through. It's going to continue to impact behavior and make people pull in. We're seeing that in places that are reopening where, very small percentages of people are choosing to go out and mingle in groups. They're still choosing to be conservative and careful with their health and their exposure, even after the official lockdowns are passed. So the recovery from this impact, this economic downturn, is going to be much slower and tougher than in past ones. And even in the past, the last recession took about a decade for employment and everything to recover back to anywhere near the cycle high. This time, Jim, we're looking at, if you caught the U.S. unemployment numbers this morning, there's now more than 30 million Americans that have made unemployment claims. This means that the loss of the last 6 weeks has wiped out all of the job gains since about 1997. It's hard to get your mind around this, but more than a third of Canadians are now dependent on the government for for income support. And this is not stimulus, in the sense that people go, oh great, they're stimulating the economy. No, this is about feeding people and keeping a roof over their head. This is basic subsistence stuff. So this is a whole other ballgame than anything people have used or have experienced in their lifetime to date.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Danielle Park. Danielle, you never were a fan of companies that bought back their own shares. Should these companies be bailed out now since they did have the money that they could have saved for a rainy day?
No, and thankfully a lot of people are starting to talk about this issue. Of course, when it's the past couple of years when they should have been managing their cash, knowing that they'd been through the longest expansion in basically in history. They'd had this fortuitous run with lots of government support and central bank support, which enabled them to, keep the cycle going a bit longer. So that should have been the sign, if you will, for prudent managers to say, holy, how long can we expect them to get, juice out of this orange? We must be building up our supplies for the inevitable downturn phase. And instead, what they did was, as I alluded to with, the Shell, the other companies that were paying dividends, they placated shareholders first. So they were irresponsible managers, and they plowed any free cash flow and indeed borrowed more money to make their dividend payments, which is in fact what BP did this week, where Shell did the prudent thing and said, holy, we have to cut our dividends because we need to shore up cash. We're in this huge crisis phase. EU banks have done the same thing in the past few years, cut dividends to maintain cash, which is the prudent management thing to do. BP opted to borrow more this week to add to record debt in order to fund a dividend. This is the very definition of reckless management. And Exxon froze their dividend, I noticed this week. But basically, this theme is coming to more sectors, Jim, because, again, anyone that's ran a small business themselves, a business owner themselves who've been responsible for managing the cash flow of the company know that you can't just, blow all of your reserves so that when a downturn or a shock comes, you have nothing to draw on. And if you take too much out as an owner and spend it on your own, a big house and flashy cars, then the business is quite likely to suffer in an economic shock. And that's always a part of a prudent management's mindset is, how do I leave enough buffer? How do I leave cash in the business? How do I keep expenses, under control so that they don't balloon out in the good times? So anyway, this is all what should have been going on, and in fact, the opposite was happening. And the most reckless managers and CEOs and executives were being rewarded for this behavior by having compensation of their own increase with the whole share scheme, because they were given compensation in shares. And so it was a very destructive model. So what I think happens in this next phase is that we get into a debt buyback focus, because we have such a mess on balance sheets, because assets are going to, mean revert, as they always do, come back down in value, and you've got this debt stubbornly high, and because in a slow growth, low income, stagnant income environment, where companies are selling less, people are making less, it's much harder to pay back debt in that environment than when your incomes are growing. And so the focus, it's typical of what went on in Japan after their bubble burst in 1989. But during that phase, everyone focuses on, how do I get this debt down? It's like this dead weight around the neck of the franchise, of the household, the company. And so they use whatever cash they have to pay down debt, right, to right size, to build up their free cash flow by lowering debt. So anyway, this is the next phase, and I think that, what we need to do, I've said this for some time, but I think that we should start tying compensation for executives to balance sheet management rather than income statement management. So rather than make it look, give them incentives to say grow the net income so much every quarter incrementally, the incentive should be if you can lower your debt leverage by, this percent, you will be compensated and we'll pay you in bonds of the company. Because if we pay them in bonds of the company, suddenly they care whether the bonds go up in value, whether the credit quality is good, whether they can be paid back. All these things focus people on risk management as opposed to speculation. And I think that's the next phase where we're headed in this economy. It's certainly what households need to be doing, and it's also, I think, what businesses need to be doing.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, finding supply chains unreliable now with China freezing supplies, and then when they promise things, sometimes they're shoddy goods or they don't show up at all. Is globalization teetering here and people want to have their own local supplies instead?
Yes. Well, I think this is a trend that's, again, been unfolding for some time. The coronavirus in many ways has just accelerated the trends that were already underway. And I think, that it's part of this sort of glut of cheap consumer goods which have flowed from Asia to here in exchange for debt that consumers have taken on in the West to be able to pay for these goods. And in the process, of course, the jobs have deteriorated. Like, for example, we're having a big oil shock in Canada again right now, but in truth, that sector has been in retreat now since 2016. The price of oil peaked in fact 2008, if you remember, Jim, and it's been over a decade now that's been coming down. And the same thing has happened with manufacturing, because a lot of the best paying jobs were in the manufacturing sector, and a lot of those positions or production has been offshored to cheaper places, whether it be Mexico or Asia, somewhere where goods can be made with less labor costs. The ability of households to consume suffered greatly, and the only way we were able to keep that whole game going was by adding more consumer debt. So if I'm correct that we're now in this, continuing into this, and it isn't beginning with the coronavirus, but the weight of the debt that accumulated over the last decade had a weight of its own, even if the virus hadn't happened, where you just have a limit to how much people can borrow, especially, as I say, when incomes are flat. And so what happens is that you have this turning away from that type of consumption and a focus more on, how can we spend less and save more? How can we buy local? I think also one of the drivers of this was an interest in a more carbon neutral footprint, frankly, of, if we make everything across the world and we ship it in tankers or fly it over, it's a very cost effective in terms of environmental impact. And of course, in many of the poorer countries where it's made, the standards are much lower. And so you're getting, a lot of pollution being put into the atmosphere from those countries. So there's just more thought going into the equation of what costs and savings actually look like and where the net benefit truly lies. And so I think that, the whole deglobalization theme was underway anyway, and then this shock has just magnified our weakness or our vulnerability in the reality that so much of our necessities, medicines, medical equipment, has also been offshored to those places. Another impact, of course, I mentioned this in the past, but coming into the new year, there was higher, more stringent carbon emission limits on transportation, so on the big tanker shipments, on it coming into the airlines as well, and all that was going to make the cost of transport that much more expensive until they transitioned at least to cleaner energy type transportation. And so in many ways, this is a big shock to the airlines, that the evaporation of traffic for sure, but they were already facing a huge challenge with how to remake themselves, how to, because of the price of carbon taxes that were going to be escalating and continuing, it was going to make that more and more less cost effective as a form of transportation, and therefore as a business model for the world, for everything to be made so far away. So I think all of this is really, now you throw on top of that this kind of phobia or concern about the fact that the virus came from China, and people's aversion to, fear of things coming in, and whether that makes us more vulnerable. So all of this is a psychological, some of it is just pure psychological, and a lot of it is actual, the math and the reality of how the trade arrangements have been. So again, it's all sort of receding, and everything in human history. I just finished reading Sapiens, which is a fantastic book. I highly recommend it. I put it on the blog this week. But basically it looks at the history of humans and our evolution over time, and all these different belief systems which we have had over the years, which, they're always just a fleeting period for so long as the group or the majority believes it is, that is how long it lasts. And at some point, there's always a sort of break in that groupthink. And when that happens, you transition to a new belief model. And I think right now that's happening with the idea of globalization. And, it's interesting because one of the things, again, we've seen this if we'd studied what happened in the 1980s in Japan, it was a microcosm of what's going on now, because they had this big boom similar to what happened with China and the developed countries in this last 20 years. At that point, everything was being made in Japan and being bought by the West, and jobs were offshoring there, and they became a big manufacturing hub, and they gained the jobs that everywhere else lost, and there was a big credit boom, and that led to asset bubbles in Japan, which burst, and the property values dropped mind-boggling amounts, similar to the 30s, frankly, in terms of losses in the stock market, losses in the property market. And what happened was people said, in the last couple of decades, they said, but that can't happen in the West, because one of the reasons Japan struggled to recover from that 30-year ago episode is that they have very low immigration and a very aged population. But if you look at what's happening in the world today, last year the rate of growth in the U.S. population was just 0.48. So that's like 0.5%, and that's the lowest since 1918. And similarly, in other countries, like you had 0.2 for all of Europe in terms of immigration. You had unchanged for China, and negative immigration for Japan, which has been typical. And in Canada, we had 1.4% of immigration. We were like a standout in the G7. But really, that had to do a lot with international students coming here to study, had a lot to do with international investors in our real estate market. So all these things sort of buoyed our real estate market, helped our economy in the short run. But those trends are very much under scrutiny right now because of, again, the shutdown of the virus, that we had protectionist rules coming in place, and we needed them because there was so much speculation in our real estate market. So again, well before the coronavirus, we had these things that were incrementally moving away from the most open immigration policy. So you can argue that that's bad, and I'm not, arguing for or against it. I'm just saying it's a reality of shifting sentiment and belief systems which are in motion, and they are becoming much more insular, local, pulling away from. So in terms of the overall, the $90 trillion global GDP of 2019 in the world, I think we're going to see a significant drop. I think we would have anyway because of these policies, because of the, spend more at home means less trade means less global growth overall. So there's some winners and losers in this for sure. But if you look at the expectations now, we could very likely see the numbers right now are sort of off the charts for anything in the modern history. But the IMF is expecting a contraction in world GDP of something like 3% in 2020. It could very well be more than that. Everyone's kind of not wanting to be alarmist and trying to underestimate and hope for the best, and hope that we get a virus shot soon. But the reality is that again, it's likely to take a considerable amount of time, and in the process, we're going to have to remake a lot of our approaches and our models, our technologies, the way that people are paid. It's interesting because also the whole share of corporate profits thing is a cycle as well. And for, a decade, the share of corporate profits was going higher and the share of labor was going down. And then a couple of years ago, those two began, because the profit cycle actually peaked in 2018. And so the profits started to come down even well before this year, and wages began to increase. So now we've got those two lines converging again, and typically now we should see a period where corporate profits suffer, retreat, contract for the next probably few years, perhaps 2 or 3 years, and that you get an increase in the cost of labor, which again takes away from profits, but ultimately helps to rebuild strength and stability in the household.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, her website jugglingdynamite.com. She was speaking to us from the Toronto area. If you have any questions for Danielle, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.